In this lecture, we're going to be talking about restricted stock, which is another form of stock-based compensation. Restricted stock are shares that are issued to employees that cannot be sold by the employee until after a blackout or vestment period. It's very important to note that when the restricted shares are granted, the shares are actually issued to the employees, but the employees just can't do anything with them until after that blackout or vestment period. And so unlike stock options, employees do not have to pay cash in exchange for the shares. If you remember stock options, they'd actually have to pay whatever that strike price was. In this case, they are just granted the shares directly. And so absent bankruptcy, the shares will have some value even if the stock price decreases. If you think about a stock option, if the strike price were $20 and the shares in the market dropped to $15, then that option essentially would become useless. In this case, though, if you were granted shares at $20 a share and the stock price dropped to $15 per share, there would still be some value. All right, let's walk through an example. Martin Corp grants each of its 150 executives 115 restricted shares on January 1st, 2018. This time the market price for the stock is $15 per share. The shares vest in 2 years and only vest if the employees remain with the firm for the entire 2-year period. The firm stock has a $1 par value. 7 employees leave the company in 2018 and 6 more in 2019. Okay, so let's talk about the January 1st, 2018 restricted stock issuance. The first account is going to be a new account, and that's called Unearned Compensation. That Unearned Compensation account, it is a contra equity account, and the account balance is the number of executives, which in this case is 150, multiply the number of shares that have been issued to each executive, which is 115 shares, and we multiply that by the price at the time that the shares are issued, the market price. And so in this case, that market price was $15 per share. And so the account balance of unearned compensation at the time the restricted stock is issued is $258,750. Now, this unearned compensation account, I already mentioned it's a contra equity account. It's actually part of contributed capital. And so the idea with this account is that the employees, there's this sort of contra account against that contributed capital account that offsets the common stock and the APIC common stock accounts, which are the other part of the journal entry. And so we can see that common stock then is credited for the par value, $17,250, and then APIC common stock is credited for the difference. And so initially, if you kind of think about this entry, we're just sort of have these shares being issued, and we have this contra equity account sitting there as well. And then over time, that unearned compensation account is going to unwind into compensation expense. And then eventually, of course, after the vestment period is up, the entire unearned compensation account balance will go down to zero, and the compensation expense will have been closed to retain earnings. And so essentially what we're doing is this issuance ultimately will be offset by a decrease in retained earnings due to compensation expense. Okay, so now the employees leave on June 1st, 2018. And so the first thing we have to record is the fact that they're going to have to return those shares. And so we have to basically undo that entry for these employees. And so common stock, the account, of course, there were 7 executives that left. Each one had been granted 115 shares, and the par value of each share is $1. And so we'd have to debit common stock $805. At the same time, we have to unwind the APIC account, and in this case, since the initial price at the time that the shares were granted was $15, it means that APIC was credited initially for $14 per share, and so now we need to debit that account for $14 per share. And then the second piece of it is we do need to unwind the unearned compensation expense, or if we had recorded some compensation expense, we'd have to unwind that as well. And so in this particular case, none of the unearned compensation has been recognized as compensation expense yet. So the entire amount needs to come from unearned compensation. And so the journal entry there is common stock and APIC common stock are the debits, and unearned compensation is the credit. So then on December 31st, 2018, we need to make an adjusting entry. I wanted you to understand, like theoretically, with every hour that the employee works, they are sort of earning those shares, and therefore the company is incurring a compensation expense. But as a practical matter, we typically only record the compensation expense as an adjusting entry prior to the creation of any financial statements. And so for this example, we're just going to create financial statements on December 31st, and so that's when we're going to do the adjusting entry. And so in this case, because it's a 2-year vestment period, we need to recognize half of the unearned compensation now as compensation expense. And so we're unwinding that contra equity account, and now we're debiting compensation expense. And we know as a practical matter, then compensation expense would be closed to retained earnings immediately after this journal entry. And so there are 143 executives that remain with the company. Again, each has 115 shares. The market price, again, was $15 per share, and we are recognizing half of it. And so that means we're going to unwind $123,338 of unearned compensation, and we're going to record compensation expense. And so the journal entry is a debit to compensation expense and a credit to unearned compensation. Okay, so we have another employee departure on August 1st, 2019. In this case, there were 6 executives that left the company. So similar to the previous entry, we do need to record the return of the shares. And so the common stock amount is 6 executives times 115 times $1 per share. And APIC common stock is debited at $14 per share. In this case, it's a little different when we unwind the unearned compensation and or compensation expense, because half has been recognized as compensation expense, and half of it still is unearned compensation. So we're going to sort of share the unwinding between those two accounts. And so again, the debit is to common stock and APIC common stock, and then the credit is basically halved between unearned compensation and compensation expense. And finally, we need to make the adjusting entry for all the employees that remain at the end of that last fiscal year. So we're going to recognize the last half of the unearned compensation as compensation expense. And so there are 137 executives that remain, and so the amount that we need to recognize is $118,163. Again, that final adjusting entry, a debit to compensation expense and a credit to unearned compensation.